Chapter 5, Deductions for and from AGI. In our final learning objective of the chapter, we will describe other itemized deductions, as well as significant changes that the TCJA made to these other itemized deductions. The first thing we want to discuss are casualty and theft losses. Taxpayers are allowed deductions for certain casualty and theft losses. The deductions may be itemized deductions, or if related to a business, deductions for adjusted gross income. A casualty is a complete or partial destruction of property resulting from an identifiable event of sudden, unexpected, or unusual nature. Examples of casualties include property damage from storms, floods, shipwrecks, fires, automobile accidents, and vandalism. For damage from weather conditions to be deductible, the condition must be unusual for the particular region. If there is a theft, then you need to be able to prove that a theft has occurred. You can do this by using a police report. As a general rule, casualty losses are deductible in the year of occurrence, but there's an exception for federally declared disaster areas. Taxpayers may elect to treat losses in a disaster area as a deduction in the year prior to the year the casualty occurred. If a return has already been filed for the prior year, you may amend the return and claim a refund on the prior year's taxes. This provision is designed to provide taxpayers with cash on a more timely basis when they have suffered casualties. In order to measure the loss, there are two rules that you need to follow. The amount of the casualty or theft loss is measured in one of the following ways. Rule A, the deduction is based on the decrease in fair market value of the property, not to exceed the adjusted basis of the property. Or the deduction is based on the adjusted basis of the property. The TCJA repealed the allowable loss for personal casualty losses, except when the loss is attributable to a federally declared disaster. You used to could take a personal casualty loss for anything, but now only if it is in a federally declared disaster area. In order to calculate the loss, you must subtract $100 floor per casualty, and the difference between your loss and the $100 has to exceed 10% of AGI. In 2017, there were certain areas deemed qualified federal disasters, and they were eligible for additional relief. These qualified disaster areas require taxpayers to use a $500 floor, but were not subject to the 10% AGI limitation. A casualty loss or theft loss is reported on Form 4684, and then the deductible amount is generally taken as an itemized deduction on Schedule A. In addition, there used to be miscellaneous itemized deductions. Well, there are still miscellaneous itemized deductions, but they are categorized in two categories: those subject to the 2% AGI floor and those not subject to the 2% AGI floor. The TCJA suspended the deduction of all miscellaneous itemized deductions that were subject to the 2% of AGI. So these items are no longer deductible. They used to could deduct them. You'd add them all together, get a total. If that total was greater than 2% of AGI, then you could take them out in excess of 2%. That is done away with now. There are still certain itemized deductions that are not subject to the 2% floor that you can still take, which includes the casualty and theft losses on income-producing property, gambling losses to the extent of gambling winnings, and other items if you'll look at the list there. Also, before the TCJA, certain high-income taxpayers were required to phase out their itemized deductions if their AGI was over a certain amount. So when you calculated somebody's Schedule A and you got down to the bottom and you got a total amount for their itemized deductions, if their AGI was, if they were single and their AGI was over $261,500, they had a limit to the amount of itemized deductions they were allowed to take. This has since been taken out. It's been phased out. So now, the way it was phased out is they were reduced by the lesser of 3% of AGI or 80% of itemized deductions other than the certain ones listed. This is a bunch of detail. Don't get too caught up in it. Just know there used to be phase outs. TCJA did away with the itemized income, the itemized deduction phase outs based on income. And you have reached the end of chapter 5.